Hi, everyone. It's Bill Kennedy from the Global Interdependence Center. We're here at Camp Kotok 2024, and I'm here with Jake Hanley. Jake, it's great to meet you.
Hey, you as well,
First
Bill.
time at
First
camp?
time this year, yes,
Well,
sir.
we always like having newbies here. Tell us a little bit about, first of all, your morning. Did you catch any fish?
Yeah, we caught four. I personally caught four perch, so we're going to be eating some of those in a couple minutes
All
here.
right.
Yeah.
Well, it's a big group, so
Yep.
we'll have to divide the fish,
Well,
right?
those four for me.
Yeah,
Yeah, that's
you
the thing. Yeah.
specifically. So we welcome you. You're from the Vermont area, just
Yes,
south
sir.
of Burlington, right?
Yep.
And so we're in your neighborhood, as it might be. But tell us a little bit about your firm,
Yeah.
what you're doing.
Yeah, sure. So I work for Teucrium ETFs. We issue agricultural commodity ETFs. So for retail investors or financial advisors looking for exposure to corn, wheat, soybeans, we have those ETFs listed on the New York Stock Exchange. And it's been really fascinating these last couple of years to see folks adopting agriculture as an asset class in their portfolio, really coming around to the idea around the low correlations
Mm.
and some of the price discrepancies and frankly, price explosions you can see. Unfortunately, with the geopolitical situation we have, Russia invading Ukraine, that was big for our wheat ETF. And now, of course, the geopolitical situation is not much friendlier. So it's been an interesting few years.
So does your firm attempt to make a forecast of the different commodity types that are out there and position the ETF accordingly? How does that
That's a
work?
great question. Our ETFs are long only,
Okay.
so they're passive strategies. We design the index and we follow our indexes. And what we're doing is really trying to educate the audience around the large cycles that grain commodities typically follow.
Mm.
And there's a cycle that we've identified called the golden grain cycle. And it's gold. You can think of, amber grains waving in the pastures, right? Or corn is yellow. But the idea here is if you identify the cycle and you pay close attention, there's a chance to potentially profit from it. And not a lot of people realize that agriculture across the world is subsidized.
Hmm.
So farmers around the world are planting every year, no matter what. And most years we have a bumper crop. So prices are going to stay at or around the cost of production. Okay, so prices, that's stage one of the golden grain cycle. Stage two, something happens. You have a bad weather year, a drought, or a war.
Something disrupts that cycle.
It disrupts the supply-demand situation and prices go up, but prices have spiked historically. And we've seen in the last 17 years now, corn prices have doubled or more than doubled from right around where they are today. Stage two. Stage three is what we've been in the last couple of years, and that's when prices come back down towards the cost of production as supplies catch back up. Because remember, farmers are planting every year no matter what, right? And so supplies have caught back up globally for corn and soybeans, absolutely. And we think we're going to enter that stage one again here in this harvest, where prices are trading back around that cost of production level, which is interesting for traders or investors, because if you're looking at a commodity that's trading around its cost of production, that might be an interesting time to start allocating.
So at Camp Kotok, a lot of conversation around policy, a lot of conversation around trade. Two questions. First, on corn and the price of corn. How much is influenced by ethanol and pricing structure that comes influence from Washington? Second question on soybean or any other tradable commodity. The demand from China, supply from Brazil and other locations. Can you just talk through that a little bit?
Absolutely. So you hit on the two things. Exports, okay, are number one. And we saw, I'll take this in reverse order. So starting with soybeans in China and tariffs, we're probably entering an era, no matter who takes the White House here, of higher trade tariffs, no matter what. And so that could cause a bit of a problem with our soybean supply in particular. China is a big purchaser of soybeans. On the ethanol side and the biofuel side, you're kind of rubbing a sore subject here because soybeans, okay, can be used for renewable diesel, which is a very clean source of fuel. And the EPA has been a little bit slow in the guidance around soybeans, but also for ethanol, for sustainable aviation fuel. Corn ethanol could be used for sustainable aviation fuel. So we have a lot of corn in the United States. We have a lot of soybeans in the United States. We have the capability to produce more. If we're not exporting that, we have to find another use for it. And there's plenty of uses. I mean, so it's animal feed, it's ethanol. There's industrial uses, cornstarch, corn syrup. There's a bunch of things you can use. Cooking oil for soybeans. But really, for those policy initiatives, we need, like all areas, clarity and timeliness.
So, not asking you to predict who's going to win on November 5th, but what's at stake from a commodity standpoint in terms of whether it's a Republican led government or a Democratic led government? How's that going to impact agricultural policy?
Yeah, from ag policy, I don't know that it's going to make much of a difference. Where it impacts the farm economy and the ag economy is as it relates to energy. And so that's where I think you're going to see more variability in policy implications, more around the margins in agriculture that might necessitate a longer video.
Which we will do, I promise.
All right.
So ETF structure,
Yep.
we get it, easy access. What's in the background? Is your team, are you acquiring futures and playing through the derivatives market? How's that working?
Yeah, absolutely. So these are futures-based ETFs, and they're designed in such a way that they're diversified across the curve. And so what that means is we don't own just 100% in one futures contract. In each of the products, there's 3 different futures contracts. And the reason to do that is to help mitigate a big, bad, scary word, which is negative roll yield, okay, or carry. And for the audience, contango, you can come to our website and see the definitions for all these things. And so we think we've designed a pretty good benchmark index for allocators, for folks who have a 6, 12-month or longer view on the price and they want exposure without that future negative roll yield.
So the ETF is actually benchmarked against a custom benchmark that you've designed.
Yes, sir.
At the firm. Okay,
Yep.
Terrific. So if somebody wants to learn more about the ETF and how to access you guys, is there a website? How do we reach out?
Talk. You have to come. No. Yes, the website is teucrium.com, teucrium.com. We're on X, LinkedIn. I'm Jake Hanley. You can find me on all those sources as well.
Terrific. Thank you very much, Jake. We appreciate your being here, and good luck this afternoon.
Thanks, Bill.
Good to see you.
Nice to meet you.
Thank you.